The sirens came first. In one coastal California city, emergency dispatchers were told to halt all non-life-threatening calls. The city's credit rating had just been downgraded to junk. Within hours, bond markets froze, payroll transfers stalled, and garbage collection was suspended. Overnight, a community that seemed prosperous was forced into crisis mode not by natural disaster or market crash, but by arithmetic. California is the world's fifth largest economy, larger than most nations, yet its fiscal foundation is dangerously thin. Decades of optimism, political overpromising, and volatile revenue habits turned budget surpluses into illusions. Beneath the state's gleaming surface lies a structural deficit hidden by capital gains, taxes, and one-time windfalls. For every tech boom, another liability quietly grew. Each Californian taxpayer, homeowner, or investor is now exposed. To understand how the state reached this point, we rewind through the decisions that converted record prosperity into a long-term liability buried inside its own balance sheet. California's fiscal instability didn't erupt overnight. It was constructed step by step through policy compromises that traded stability for popularity. The first layer was Proposition 13 inches 1,978, the measure that limited property tax growth to protect homeowners. It did that successfully, but it also capped local government revenue growth permanently. Cities lost predictable property tax inflows, forcing them to depend heavily on state transfers and volatile sales taxes. Over time, this created a built-in mismatch between what communities needed to maintain services and what they could legally collect. The second fault line emerged 2 decades later. During the late 199 seconds boom, the government approved pension enhancements for public workers, assuming investment returns would cover the cost. CalPERS, the state's powerful pension system, projected near double-digit annual yields. Those assumptions never held. When the dot-com crash hit, returns fell, yet the benefits remained locked in by statute. Instead of recalibrating, lawmakers refinanced the promise, committing future taxpayers to obligations that would multiply across decades. Add to that a third vulnerability: California's deep reliance on capital gains taxes. Roughly half of the state's income tax revenue comes from the top 1% of earners, people whose income volatility directly tracks market cycles. When markets rise, tax receipts soar. When markets fall, the Treasury seizes. In good times, Sacramento celebrated budget surpluses. In downturns, deficits the size of entire state programs appeared within a single fiscal year. The revenue model became as cyclical as Silicon Valley itself. This structural contradiction, progressive spending attached to unstable income, defines California's vulnerability today. Political leadership reinforced it by expanding social and environmental programs without creating parallel revenue cushions. Every new initiative carried recurring obligations: payroll, pensions, infrastructure maintenance. Yet the tax base funding it was concentrated in tech and real estate, 2 of the most volatile industries in the economy. Inside the legislature, incentives rewarded short-term narratives. Promising teachers' salary increases or infrastructure bonds won elections. Tightening pensions or delaying projects did not. The result was a fiscal policy built for political survival, not resilience. Officials proudly announced balanced budgets, but those often relied on accounting maneuvers, deferred payments, temporary transfers, or optimistic investment assumptions that exaggerated future returns. On paper, California thrived. In reality, its liabilities were compounding faster than any growth metric could offset. The rhetoric of abundance masked the arithmetic of debt. Governors from both parties celebrated the image of California as an economic leader, emphasizing GDP growth while quietly borrowing against future tax streams. Non-discretionary spending, especially retirement obligations, expanded until it consumed more than half of general fund expenditures in several fiscal years. Local governments mirrored the pattern. Counties issued bonds for essential projects while underestimating maintenance costs. Cities refinanced pension obligation bonds to delay payouts, pushing expenses further down the line. From the outside, The policies seemed to function. Schools stayed open, salaries were paid, and freeways kept moving. But the equilibrium depended on uninterrupted growth. The moment capital markets slowed, the illusion shattered. One recession could erase a decade of fiscal optimism, exposing how deeply the system relied on speculative wealth. California's prosperity narrative was never a lie, but it was incomplete. The economy did grow, yet without structural reform, it also outgrew its fiscal architecture. The foundations built under Proposition 13, inflated pensions, and revenue volatility ensured that economic booms disguised long-term deterioration. Officials called it flexibility. Investors now call it risk. But while budgets looked balanced on paper, the debt was already compounding beneath the surface. The scale of California's fiscal exposure isn't abstract, it's quantifiable. The state's official unfunded pension liabilities, the gap between what's promised to retirees and what's actually available in the funds, exceed $500 billion when using realistic return assumptions. CalPERS and CalSTRS, the two largest pension systems, base their forecasts on investment returns around 7%. But for the past decade, average yields have been closer to 5%. Each percentage point difference represents tens of billions in missing assets, effectively pushing those costs onto future taxpayers. Take CalPERS as the example. When returns undershoot projections, contribution rates from cities and counties rise automatically. In the last 15 years, local employer contributions more than doubled. Municipalities now spend more on pensions than on infrastructure maintenance or public safety staffing. Some counties have resorted to issuing pension obligation bonds, borrowing money to invest in the same markets that failed to meet targets. It's a circular fix that deepens vulnerability every time volatility appears. The parallel story plays out in CalSTRS, covering public school employees. Teachers are promised benefits indexed to years of service, yet contributions rarely cover accruing costs. The shortfall compounds annually, increasing pressure on the state's general fund. Even modest market corrections widen the gap fast enough to erase entire education budget gains. The arithmetic leaves little margin for error. What looks like a 2-year fiscal cushion can evaporate in months. Unfunded pension debt is only part of the equation. Layered on top are retiree healthcare obligations, over $100 billion in liabilities statewide. These aren't pre-funded accounts but rolling promises, meaning each year's active workers pay for current retirees. The longer reform is delayed, the steeper the ramp cost becomes. Unlike pensions, these benefits lack defined assets. They're future expenses without matching savings. At the municipal level, the same structural weaknesses magnify. Recent audits show dozens of cities where long-term liabilities now exceed total annual revenue. San Bernardino and Stockton, both previous bankruptcy cases, remain cautionary precedents. When city pension costs approach 1/3 of payroll, basic services shrink. Deferred roadwork, closed libraries, and thinning emergency response times become visible symptoms of accounting errors made decades earlier. Bond markets see it too. Credit agencies like Moody's and S&P don't react to ideology, they react to math. Over the past few years, multiple local governments have received either outlook, downgrades, or warnings tied to pension exposure and slowing revenue. The state itself still maintains high ratings due to its economic scale, but investors demand higher yields from certain municipal bonds, silently treating them as higher risk. When your borrowing cost rises even 0.5 percentage point, servicing past debt becomes exponentially harder. The fiscal cushion often cited to show solvency, the so-called rainy day fund totals tens of billions. On the surface, that sounds strong, but relative to liabilities exceeding $1 trillion, it's minor. That reserve covers only a fraction of 1 year's operating budget. If asset markets correct or income tax receipts fall 10%, the cushion disappears before any emergency spending begins. California's rainy day, in actuarial terms, already arrived. It's just been raining quietly for years. Revenue volatility compounds the danger. Roughly 40% of general fund revenue comes from capital gains taxes and high bracket earners. That means fiscal stability depends not on steady payroll growth, but on stock market performance. In expansion years, budget surpluses tempt legislators to commit new recurring expenses. But when the market dips, receipts plunge, producing sudden multi-billion-dollar holes. Analysts estimate that a typical recession could cut income tax inflows by 12 to 15% in a single fiscal year, translating into a shortfall greater than the entire budget for higher education. Meanwhile, infrastructure continues to age. Deferred maintenance across highways, water systems, and public transit adds nearly another $100 billion in outstanding needs. Those aren't merely physical problems, they're future liabilities requiring annual servicing. The current budget assumes continued population and employment growth to cover them, yet both metrics have shown stagnation. Outmigration of higher income residents further weakens the revenue base. The measurable indicators reveal a consistent pattern: rising obligations, slowing revenue resilience, and shrinking fiscal flexibility. California's balance sheet still reflects wealth, but that wealth is increasingly leveraged against assumptions. Bond markets already price the risk. Taxpayers will soon feel it. Those numbers are more than statistics. They determine whether essential services survive the next downturn. Fiscal deterioration never stays confined to spreadsheets. It moves through households, wages, and neighborhoods. The first visible effect appears in local budgets. As employer pension payments rise, city departments are forced to adjust. Hiring freezes start quietly. One position postponed here, a maintenance project delayed there. Within a fiscal year, residents notice slower 911 response times or fewer open hours at libraries. What began as a balance sheet issue turns into an everyday service gap. Higher contribution costs also drive local tax increases. Property tax surcharges and parcel assessments expand under different names, but all feed the same obligation: retirement debt. When public employees retire earlier and live longer, annual payouts escalate while workforces shrink. Remaining taxpayers, already burdened by some of the nation's highest housing costs, absorb the difference. Median homeowners in several counties now pay thousands annually in additional local levies earmarked not for new services, but for promises made decades ago. The pressure extends into paychecks. Public sector wage growth slows as pension costs cannibalize operating budgets. Teachers and firefighters negotiate smaller raises even as contribution deductions climb. Private sector workers feel it through reduced disposable income sales, or use taxes fill gaps left by declining income receipts. For the average Californian, fiscal instability shows up less in headlines and more at the grocery line. Housing compounds the strain because Proposition 13 limits how fast assessed values rise. Municipalities chase alternative revenue by approving new development rather than managing existing infrastructure. The predictable result is overbuilding in tax-efficient categories, luxury units, and commercial projects that maximize fees upfront. Meanwhile, affordable housing lags. The mismatch inflates property prices faster than income growth. When mortgage rates rise or tech valuations fall, demand cools abruptly, threatening revenue streams dependent on transfer and construction taxes. The domino effect continues when municipal credit tightens. Cities facing higher borrowing costs defer capital projects. Deferred projects create employment slowdowns in construction, engineering, and logistics industries that once provided the middle-class ladder. Each step back in local investment translates into lost private payrolls, reducing sales tax inflows and widening deficits. It's a self-reinforcing loop where fiscal caution becomes economic contraction. Migration amplifies it. Households and businesses with flexible income relocate to states offering lower tax loads and lighter regulation. Since top earners account for a disproportionate share of state income taxes, even a modest outflow shifts revenue curves sharply. IRS data confirm a steady net migration of high-income filers from California to Texas, Nevada, and Arizona. These departing taxpayers take payroll, consumption, and capital investment with them, leaving behind retirees and lower-income residents who depend more heavily on public services. As the denominator shrinks, per capita pension liability rises. Every departure makes the balance sheet weaker for those who stay. The ripple reaches public utilities and infrastructure. Aging water systems require billion-dollar upgrades, but funding them competes directly with retiree obligations. To preserve credit ratings, agencies raise rates on consumers rather than issue more debt. Energy regulators follow similar patterns, approving cost pass-throughs that raise electricity bills to cover deferred grid investments. Household budgets tighten further, and local businesses face higher operating costs, reducing competitiveness against neighboring states. Education systems absorb the next shock. School districts tethered to property tax valuations experience cyclical revenue swings. When housing transactions slow, districts dependent on parcel taxes cut programs. Layoffs of younger teachers become common, even as retirement benefits consume a larger portion of school budgets. Families see the decline in class sizes and course options, prompting some to relocate or enroll in private schools. An exodus that further erodes district funding. Consider one mid-size inland city forced to make trade-offs in real time. Rising CalPERS rates pushed annual pension expenses up 20% in 3 years. To remain solvent, officials froze hiring in emergency services and delayed street repair contracts. Residents complained of slower ambulance arrivals, yet the city's budget reports still described conditions as stable. On paper, obligations were met. In practice, public safety was rationed. This is how fiscal erosion becomes visible, not through defaults, but through diminished capacity disguised as efficiency. Secondary crises multiply from these initial cracks. Transportation projects rely on matching funds from both state and federal sources. When state deficits swell, allocations stall, delaying transit upgrades that would have supported housing density goals. Energy reliability declines because maintenance budgets compete with pension transfers. Even environmental initiatives, water recycling, wildfire mitigation, face funding, squeezes despite political priority. Each deferred project adds hidden costs later, as infrastructure ages and emergency repairs grow more expensive. The cumulative effect is stagnation. A state once defined by constant expansion begins to experience the arithmetic of maturity. Slower population growth, flat productivity, and declining fiscal mobility. Wealth persists in concentrated sectors, tech, entertainment, finance, but the public ledger beneath them weakens. Economic prosperity without fiscal discipline functions like leverage, profitable until the cycle turns. These dynamics expose an uncomfortable truth for voters and investors alike. California's challenge isn't affluence, it's allocation. Money exists, but commitments outstrip sustainable revenue. The resulting strain touches every civic layer, from city halls balancing payrolls to families recalculating budgets under rising utility and tax bills. The illusion of limitless growth gave way to the mathematics of maintenance, and maintenance is far less forgiving. These visible cracks exposed another problem, political denial wider than any budget gap. For years, California's leaders told a reassuring story. The budget was balanced, reserves were healthy, and the state had finally evolved beyond its boom and bust cycle. Technically, none of those statements were false, but they depended on assumptions as fragile as the markets that sustained them. Every surplus announcement masked the same underlying pattern: temporary revenue spikes, treated as permanent income, and one-time windfalls folded into recurring programs. Inside legislative hearings, analysts warned about long-term obligations, but optimism always won the vote. Public discourse hardened around partisanship rather than arithmetic. Each election season resurrected the same ritual arguments about tax fairness and spending priorities. Conservatives blamed bloated welfare programs. Progressives blamed corporate loopholes. Both camps ignored the mathematical constant, tying every crisis together: unfunded liabilities, growing faster than tax receipts. The adversarial framing turned fiscal management into an ideological sport rather than a sustainability exercise. As long as voters were entertained by the debate, accountability faded. When the pandemic relief years brought federal transfers, Sacramento declared victory. Billions in Washington funding filled gaps created by earlier volatility. With those dollars, the state expanded new climate programs, housing initiatives, and education spending. Few questioned whether those sources were permanent. They weren't. By the time federal aid expired, the commitments made on top of them had become baseline obligations. Rather than unwind them, officials reclassified emergency funding as transitional support and borrowed modestly to maintain continuity. The illusion persisted, at least on paper. A subtler form of denial came from bureaucratic inertia. Pension reform proposals were introduced, modeled after hybrid plans used in other states, but each was met with political resistance. Adjusting benefit formulas for current employees risked fierce union backlash. Applying changes only to new hires produced minimal short-term savings. Every compromise preserved the storyline that reform was underway, while the actuarial math stayed unchanged. For legislators, incrementalism was a survival strategy, the appearance of progress without the consequences of confrontation. Even external watchdogs learned to phrase their warnings diplomatically. Auditor reports replaced unsustainable with structurally challenged. Credit agencies issued cautions in muted language to avoid triggering panic in bond markets. This cultivated a culture of gentle understatement around what was effectively a ticking fiscal hazard. Economists who highlighted worst-case scenarios often faced dismissal as alarmists, despite their projections aligning closely with long-term debt simulations. The system's success at softening its own bad news became its biggest weakness. Meanwhile, the political media reinforced selective optimism. Headlines celebrated budget surpluses, while footnotes mentioned pension obligations in passing. Television segments showcased infrastructure ribbon cuttings financed by debt issuance, still pending repayment. The public rarely saw the connection between the ceremony and the liability. That informational asymmetry kept voter pressure minimal, granting lawmakers freedom to postpone recalibration. By the time the broader public grasped the gap, debt service had become one of the fastest-growing line items across multiple city budgets. Comparisons to other regions grew unavoidable. Analysts pointed out that Florida, despite its political turmoil, maintained lower pension exposure as a share of revenue. Utah and Texas, with stricter balanced budget rules, preserved cushions that California envied. Instead of learning from those models, California officials dismissed them as incompatible due to different economic structures. The reality was less complex. Those states spent within predictable revenue limits. California continued betting on perpetual expansion. Investors noticed before voters did. Municipal bond buyers began demanding slightly higher yields, signaling perceived risk premium. It wasn't panic. It was quiet repricing of trust. For the first time, political denial carried measurable financial cost. The irony was unmistakable ideological paralysis sold directly into the market as higher interest expense for taxpayers. Inside Sacramento, the prevailing mood remained upbeat. Officials highlighted population recovery and venture capital inflows as evidence of resilience. But private discussions among budget analysts told a different story. Trend lines pointed toward structural imbalance, even under optimistic growth scenarios. The gap between narrative and number widened month by month. This loop of denial political optimism overriding arithmetic sustained California's illusion of stability, far longer than fundamentals justified. Each recycled success story delayed necessary course correction by another fiscal cycle. Debt didn't explode suddenly. It accumulated quietly under layers of reassurance. The denial continued until recession risk turned forecasts into balance sheet emergencies. Section 5. The recession trigger. The spark could come from anywhere: a market correction, a sudden drop in IPO activity, or a few quarters of slowing tech earnings. California's fiscal stability depends so heavily on capital gains taxation that one prolonged downturn can slice billions from the Treasury almost overnight. Picture income tax receipts falling 15%, while mandatory pension contributions continue rising. By the next fiscal year, the state budget posts a double-digit deficit before cuts even begin. The cascade starts immediately. When state transfers shrink, local governments lose their safety line. City managers freeze new hires and delay vendor payments. Capital projects are postponed, draining construction pipelines. As sales taxes decline, county budgets follow, reducing funding for essential programs like healthcare and fire management. A single synchronized contraction spreads through multiple levels of governance, each amplifying the next. In this environment, behavioral reactions deepen the damage. Wealthier residents accelerate relocation plans, selling properties while valuations remain high. Real estate turnover, a crucial local tax generator, collapses. Newly vacant homes generate less sales tax activity, while remaining owners face higher assessment fees to fill budget gaps. Outmigration thus converts a temporary revenue drop into a structural erosion of future income. Private investment retreats simultaneously. Venture capital funding tightens. Startups scale back hiring. Payroll taxes stagnate, and unemployment claims rise. The state's vaunted diversification technology, entertainment, agriculture provides less shelter than expected because all depend, directly or indirectly, on high consumption and credit conditions. Retail receipts fall, income inequality widens, and pressure for government relief builds precisely when coffers are weakest. CalPERS illustrates the compounding effect in real time. During a recession, asset valuations decline, but benefit obligations remain fixed. To rebalance, the fund raises employer contribution rates. Cities already struggling with revenue shortfalls must now divert an even larger share toward pension costs, cutting services further. In previous downturns, it took years for markets to recover those losses. Each new cycle leaves less margin for recovery before the next one begins. Credit markets notice long before the public does. When rating agencies downgrade state or municipal debt, yields widen across the entire borrower pool. A half-point increase on tens of billions in outstanding bonds consumes hundreds of millions in new interest costs. Investors view it as rational repricing. Taxpayers experience it as hidden taxation. Projects once considered affordable bridge retrofits, wildfire mitigation, public transit upgrades suddenly exceed borrowing limits. Deferred maintenance climbs, while overall indebtedness still rises. The social dimension follows the financial spiral. Service reductions touch visible areas first. Parks unkempt, potholes unrepaired, fewer community college courses offered each semester. To an individual resident, these appear as minor inconveniences. In aggregate, they erode quality of life and confidence in institutions. Diminished confidence further accelerates capital flight. Businesses interpret civic neglect as risk, choosing warehouses in Nevada or headquarters in Texas, where local infrastructure remains reliable. Politically, recession removes the last refuge of denial. Lawmakers can't blame volatility when the math is plain. Emergency budget sessions return to old templates, temporary borrowing, accounting adjustments, deferred capital spending, but investors now discount those tactics. The promise of future growth no longer balances immediate obligations. Without reform, even recovery years merely reset the countdown to the next crisis. Comparative states highlight the alternative. Utah, operating under strict balanced budget provisions, maintains reserves covering nearly 10% of annual spending. Texas, despite leaner taxation, spreads its revenue base across energy, logistics, and manufacturing. Both can endure recessions without slashing core services. California's structure, by contrast, is optimized for expansion, not contraction. It rewards momentum but punishes stability. A single fiscal winter reveals how little insulation the golden economy truly has. The logical outcome of these dynamics is self-reinforcing austerity. Each cut triggers revenue losses that justify further cuts. Pension funds raise contribution demands precisely when local payrolls shrink. Bond markets impose higher spreads exactly when borrowing is needed most. The fiscal model folds inward until reform becomes unavoidable or insolvency intervenes. The lesson is brutal but direct. When ideology ignores arithmetic, Math wins every time. Decades of fiscal optimism have stacked promises far beyond the capacity of even California's vast economy to honor. What looked sustainable during tech expansions was, in fact, a leverage play on volatility. Each new program, pension promise, or tax credit was financed by tomorrow's expected prosperity, creating a liability pyramid dependent on continuous growth. That growth has slowed, and the arithmetic can't be delayed forever. The broader meaning is simple. Prosperity without fiscal discipline transforms wealth into exposure. California's wealthiest years built the scaffolding for its financial fragility. Yet awareness brings opportunity. Observers who track debt ratios, bond yields, and outmigration data gain early warning of recession stress. Businesses with diversified footprints can hedge before austerity sets in, and investors can price risk more accurately when ideology no longer masks numbers. California's future still depends on confronting its own accounting. One reform cycle could stabilize obligations for generations. Continued denial guarantees contraction. Use this analysis to inform your next move. We'll be back next week with the next phase of the economic shift.